Today we are talking about buy-to-let mortgages. A buy-to-let mortgage is a product taken out on a property that you do not plan to live in. The property is purchased as an investment with a plan to let it out for a profit. Very few lenders will offer a buy-to-let mortgage to a first-time buyer. When they do, certain conditions must be met, such as minimum income requirements. A typical buy-to-let mortgage loan-to-value is 75%. So on a £100,000 purchase, you have to raise a deposit of about £25,000. Interest rates are also typically higher than on those offered for residential mortgages. Lenders want every borrower to have one residential mortgage, but you can have as many buy-to-let properties as you like. However, some lenders do impose limits. For example, you can have a maximum number of buy-to-let mortgages with them, such as 3, or you can only borrow about £1 million with them. However, there are some lenders that love professional landlords, so the more buy-to-lets you have, the better. The maximum loan you can borrow is usually based on the rental amount. The calculation used usually takes into account a rental cover of around 125% and an interest rate of about 5%. A mortgage calculator or a mortgage advisor can help you figure out the max you can borrow based on the rental income. The deposit required on a buy-to-let mortgage may be higher, but you can get them on an interest-only basis, therefore increasing your cash flow.